Welcome to the Croner Taxwise webinar programme. Do remember that all these webinars are CPD accredited, and do go to our website and download the notes.
Hello and welcome. My name is Pat Noun, and on behalf of Croner Taxwise, I'm going to just take you through some topical issues in relation to tax and pensions. There are a number of pitfalls that I'm going to talk about that we need to avoid, and of course it's all about trying to ensure we maximise our tax relief on any contributions that we make, and also make sure that when we access our pension fund we do so in the most efficient way. So first of all, of course, there is a distinction between us making personal pension contributions and maybe an employer making contributions. In the owner-managed business sector, it's very common for director shareholders to get their companies to make contributions on their behalf, quite often to independent self-administered pension schemes, as well as the individual. Now, the problem with personal pension contributions, a number of areas that we have to watch here, is that of course we only get tax relief if we have relevant earnings. And so it's not a disaster, of course, if as a director shareholder you're taking out a minimum salary from the company. It does mean, of course, personally that you can't make extensive pension contributions because you haven't got the earnings to support it. You can use that employer contribution facility. But it might be something that we need to consider in respect of other types of clients. One planning technique that we can think about using in personal tax planning is where maybe we have a spouse who doesn't have earnings to support pension contributions, and we can still, of course, put pension contributions and get tax relief on that into a fund as long as we don't exceed the 3,600 limit per year. So that's something we should consider doing. If we're looking at ensuring we maximise tax relief generally for pension contributions, then the mechanics of how we get that tax relief can sometimes cause issues. There are actually two ways of getting the tax relief from the perspective of being an employee, which is where I come across this particular issue the most, and that is relief at source or net pay. If you ask the average person, do they know if the pension contribution that they're making as an employee is under relief at source or net pay, they often don't know. But it's actually quite critical for higher rate taxpayers and additional rate taxpayers that we know the answer to that question. If somebody is paying their pension contribution through payroll under a net pay arrangement, the way in which that works is the contribution is coming off their gross salary. So if they were a higher rate taxpayer, they'd automatically get the 40% tax relief they're entitled to. But if the scheme operates a relief at source, then technically they're paying their net contribution, if you like, out of net pay, into the fund. Government then tops that up with the 20% basic rate relief. But it does mean that the taxpayer hasn't had their additional 20% relief because that's only affected through a claim on the self-assessment return. And I've come across even accountants over the years, let alone other clients, who basically did not understand that that was the position with a relief at source and therefore have potentially lost out on some tax relief. So that's certainly something that's worth considering. The other thing that we need to think about in relation to tax efficiency, if you like, is the client that has income over £100,000. Pension contributions is one of the methods, if you like, one of the easier methods that we can utilise to reduce somebody's income to the £100,000 mark. The significance, of course, of that marker being that you start to lose your personal allowance when you get above the £100,000. And the problem with that is, of course, that that's expensive. It's a 60% marginal rate of tax, so pension contributions can be used for that purpose. Going forward, in 2017-18, that will be the second year where we'll have to also pay attention to those that have high incomes and look at ways in which we can try and reduce their income so that they don't suffer from the tapered annual allowance. The effect of the tapered annual allowance is that it reduces your annual allowance from the maximum of 40,000 maybe down to 10,000. The reality is that the sort of people who are affected by the tapered annual allowance have high incomes and therefore also likely to be the same individuals who would be perhaps putting high amounts of contributions into their pension funds. I don't want to get too technical on this, but essentially if somebody has income above 150,000, then they could be in the tapered allowance zone. There are various tests we have to look at in assessing whether they are caught, including something called, as well as their one definition of income of being over 150,000, we have to look at another definition of income, and that has to be over 110,000. And if both of those requirements apply, then they lose some of their annual allowance. And there are ways in talking to your advisor whereby we may be able to alter the particularly who pays the pension contributions in order to try and ensure that we don't breach these income limits and retain the full 40,000. So that's something to bear in mind. Another area on the annual allowance we need to be careful of is to understand, and if we don't, to seek advice. And this is really aimed at the over 55s, those that can flexibly access their pension funds. It's quite common for people at 55 and above now, because they can, even though they have no intention of retiring yet, to maybe want to take out some money from their fund for a specific purpose, like travel, for example. And if they do this incorrectly, in other words, if they don't approach it in the right way, they might find that when they subsequently want to make more pension contributions into their fund, that their tax relief is severely limited. And this is because of something called the money purchase annual allowance. And that has changed this year in the finance bill. If you were triggered the money purchase annual allowance, then you risked your annual allowance going forward for money purchase schemes only being £10,000. And that has now reduced further to £4,000. So it's very important, if you're going to flexibly access a money purchase scheme, that you take advice before doing so to make sure that A, you get your hands on the extraction of money efficiently, and B, that you don't trigger the money purchase rules. And that's all for me for now. Hopefully you'll find some of those areas interesting.